Why did the real estate investor have to go to therapy? Because he had too many distressed properties. That's right. This is my way of spicing things up because we are talking about real estate finance today on the Furlough Capital Real Estate Podcast, where we dive into the intricacies of passive real estate investing. And our mission is to equip people to invest wisely in both people and residents so that together we can build wealth while improving housing. I'm James, and this is my not laughing wife, Jessi.
That was awesome. I like a good joke.
Okay.
I chuckled.
Okay, that's good.
You know, I don't know if that was a laugh out loud quality, but
I'm
it was
trying.
a chuckle.
Okay.
It's a good. I'm like the cornier dad joke, the better. If I have to think about it, which that one I was like, I gotta think first. Oh, okay. I got you.
Okay. Fair enough.
It was good though. That was good.
Good.
I like the effort. I like a good joke.
We're talking about finance, right?
Right?
It's not that interesting.
It could be boring, but it won't be. It won't
Some
be.
people think it's really interesting.
This will be super interesting.
Yeah, so, okay, I'm going to challenge myself again because this is part of an 8-part series that we're taking our sweet time to get through.
Which is fine.
Where essentially, when you are looking into doing a deal, there are 8 different things that you want to look at, right? And they to go from talking about the sponsor to the property manager.
You can do this.
Talking about the market, the property itself. You want to look at the construction plan. You want to look at the, what number am I on? At the property projections themselves. You care about the legal documents. What we're talking about today is the financing and loan stuff.
All right. That was awesome.
I think I got them all.
I would not have been able to do that.
Yeah, so that's what we're talking about, which is like a super critical. I mean, they're all important. Otherwise, I wouldn't have included them. But these are like
make or break,
really important
ideas here, because
and often just straight up confusing. You know, it's like I don't know.
I was briefly glancing at this and was like, what does that mean?
Yeah, so there is a download that you can get on our website, furlough.com. That has all of these questions and all, and more. There's, I forgot. It's like 160 something. There's a ton of questions. And then what we do is we highlight the ones, like these are actually the most important ones that you should pay attention to. Yeah. So you can have it over the website, play along if you want. But so what I've done is I've given you this part of it, the financing and loan, for you to look through.
And the context is like this list of questions is if I'm interested in investing in something. Yeah. These are the questions I should be asking.
Yes. Okay. Yeah, that either the sponsor should pre-answer or you want to ask because you care about it.
Right.
Yeah.
So finance.
Yeah, finance.
Here we go. Okay, so just before we dive into specific questions, because this gets very specific very fast. Yeah. Give me the 30-second or shorter concept of what do you mean when you say financing a property?
Yeah, getting a loan, getting debt.
So it's like borrowing money to buy something.
Yes.
Yep. Okay, that's the most straightforward, and it doesn't matter who it's coming from.
Yeah, and if you're part of a syndication, usually you are providing funds. You're an owner. You're an equity partner with it. Yeah, and then there's often a loan that comes along beside it, or
from a bank, part of that capital or stack. From someone else.
From a bank. Yeah, okay. Exactly. And so you as an equity person, as an equity owner, you want to know, well, what kind of loan are we getting? What's going on here? What are the terms? What are the risks? That kind of stuff. And all these questions help to suss that out. And even if you are doing a short-term loan and you are one of the lenders, right? You're saying, yeah, I'm giving you money. It's important to know, well, how is this thing structured just from my standpoint as a lender? And you want to make sure that whoever you're giving the loans to, they're not getting themselves in trouble and over-levered because then you potentially have a problem.
They can't pay you back. Yeah.
Yeah.
Okay, so you want to know if the debt matches the business plan and the level of risk the debt creates is something that you can handle. So question 1, or where this starts, is how much leverage?
Yeah, what question is that actually in my list?
153.
Yeah, see, there's 152 other awesome questions before you even get to this.
Even more. I think there's 190 something.
Yeah, I think you're right.
Yeah, because this goes
I think it's
178.
196. Sounds right to me.
A lot. That's a lot. It's good.
Not even 200.
So how much leverage, aka loan to value, is used to purchase the property?
Depends. Oftentimes what you hear is people talk about it being like 70, 75%. And that's really just the back of the envelope rule. The honest answer is it depends on the cash flow of the property in terms of its income to expense ratio and what the interest rate is on that loan, because you want to make sure you have enough money, you make enough money from a net operating income standpoint to pay back the loan plus have some additional to it. But
That makes sense.
typically, you're going to see, if you see someone saying, hey, the LTV on this loan is like 50%,
Mm-hmm.
you're going to be like, tell me more. Why are you bringing so much cash to the table? And if they say like it's 90, 95%, again, you're going to be like, tell me more.
Why is someone leveraging that
bank
much?
letting you get away with that?
Yeah. Can I have their number?
Yeah, exactly.
Yeah. Okay. So there's a range, and
Yeah.
that range is
If
you know,
if it's in the 70s,
somewhere in the 70s.
maybe mid 60s,
Okay.
that's about right,
awesome.
depending on economic stuff.
Another question you might need to ask is there, this is the one that I was like, what? Is there preferred equity in the deal that would be senior to your investment?
Mhm.
So, like, walk me through equity and how that all works.
Okay, so there's what's called the capital stack. So
Mhm.
that's all the money that went into the deal in order to make it happen. And so
Okay.
with syndications, there's multiple different levels with it. So you might have, first and foremost, you get a loan. So you have to make loan payments. That's usually number one in the stack. And then
When you're paying people back.
yes, when you're paying people back,
Okay.
right? You got to pay the loan first. And then you have all your equity peeps.
Mm-hmm.
They get paid essentially last, the profits of the property.
Mhm.
Okay. Well, sometimes there's a middle group in there where you can say, okay, you are technically equity, but we're going to treat you like debt in the sense that we're going to give you a fixed regular amount of interest
Mm-hmm.
as an equity holder, as a preferred equity holder. And so it allows you to continue to have the loan. It doesn't put them in a second position, but they also don't get to share in any potential massive upside. Instead, they get guaranteed returns. Because you have some people who are like, yeah, man, I would love to invest in this bigger deal. And I'd rather get a guaranteed, I don't know, 9%, 12%, which sounds awesome. 9% usually. And I say, yeah, give me that. Even if the property overperforms, I want the guaranteed 9% for the hold period, those 7 years.
Okay.
And so the order is bank goes first, preferred equity goes second, regular common equity goes last. Now, the bank, they get a fixed interest rate, right? Whatever it is, that's what they get.
Yeah.
The preferred equity people, they get a fixed interest rate. Whatever it is, that's what they get. The standard normal equity holders, I don't know. If the deal goes bad, they may not get much.
Oh.
But if it goes gangbusters, maybe they make a ton.
Okay. So
Things also get super crazy when you sell the property. It can also affect you, but go ahead.
that just seems a little weird to me because it's like if the sponsor has like ran all the numbers and knows how much this property is worth, how much they're putting in, they have a projected return, like there's not a ton of risk. Like being on the bottom level is like, if you have a good sponsor, like you're going to get some return
If you have
on
a good
your
sponsor,
investment.
which is part one,
All right.
what you need to ask about.
Sure.
And again,
I guess that's my assumption.
there's some
but-
people who are like, oh, I just want the regular number. I don't want a fluctuating thing. I want the predictable amount. And so it's the sponsor trying to be flexible in what they're offering their folks.
Do all sponsors offer preferred equity spots?
It depends on the deal. I tend to not do it, to be honest.
Yeah.
It seems to me like you're kind of like, this feels like a level of complication that
Right.
you don't necessarily need. I suppose if someone came to me, they're like, hey, man, I
And
just
they
want that
wanted
guaranteed
that.
9%. I'd be like, okay, cool. Now, what I do is I do a hybrid. So you still can get a loan. But then what I will offer is a preferred return to the regular equity people. So I'll say, hey, look, no matter what, I'm going to give you 9%. You're good. It's as if you are preferred equity, but then you also get to share in the upside. But the way I'll set it up is there's different hurdles where it's like you get that guaranteed 9%. And then after that, you and I, we're going to split it 20-80, 30-70, whatever. And then if it really overperforms and your return gets to like 15%, now we're going to split it 50-50 because I did awesome.
Yeah.
And I get rewarded for that. That's usually how I set it up. 'Cause
Interesting.
It seems like a good balance of fair and it's most straightforward and keeps the cap table from getting crazy.
I know the bank is the one that determines, percentages and things on and how much they're willing to loan to you, but are you as the sponsor determining like how much you're willing to give as a return for private investors and equity investors? Or is that kind of a standard number that comes from somewhere?
No, I'm the one who determines that. And it's more like, I mean, at the end of the day, the deal determines what that number is going to be.
Right, you run the numbers.
I'm the one who decides, is this good enough for my investors? Have I been conservative enough that this will actually work out for them and they'll be able to get that return?
Okay.
So that's what I determine. Yeah.
I just learned a lot just then. That was amazing.
That's why you listen to this.
Now I know what preferred equity is and how it fits in the, what did you call it? The stack?
Yeah, the capital stack.
When you said capital stack, I just thought of like a big stack of pancakes, but I don't know why. And that's what I was envisioning the whole time, and now I want pancakes.
Okay, hold on. I potentially got another one for you. Oh my gosh. Where was it? Why did the investor refuse to flip pancakes? They didn't want to over leverage their stack. That's such a dumb joke.
You know, because I envisioned pancakes, it totally makes sense to me.
As you can see, I was doing the research trying to find a good joke.
There's that, but there's also, this is like really tangentially related.
Okay.
It's one of my favorite SNL sketches ever.
Okay.
And Barb.
Oh, Barb Kilner.
Barb Kilner. She comes in and wants a little stack of cash.
She does, right, for her pizza business.
Or pizza eater business.
Pizza eater business. That's right.
Anyways, if you can find that,
leftover pizzas.
The pizza eater, it's fantastic.
Hilarious.
But she is trying to get a loan, and she wants it in the form of a little stack of cash.
Little stack of cash.
Maybe you can get that from the bank. Can you just bring it out in a little stack of cash for me?
Yeah, the accent really sells it.
Can I just sign this? Okay. Anyways, that was off track. Back on track. To what extent does the property cash flow from day one? I love this question because I think all properties should cash flow from day one. But I realize that's not always the case. There's maybe a longer term investment and you're putting some sweat equity in and increasing value and there's other factors.
But it's good to know.
It's good to ask.
Yeah.
What's the cash flow? What does that look like?
Yeah, it doesn't necessarily have to be positive. Obviously, that's a positive sign if it's positive.
Sure.
And you really want to make sure, like, okay, is this like a 3-year thing we're going in the hole?
Yeah.
Or is it like a 9-month thing while we do the transition? Yeah.
Well, and you're thinking through things like the debt coverage service ratio, what's the duration of the loan, the loan's amortization schedule. So like the loan versus time, does it make sense?
Yeah. By the way, the debt service coverage ratio, very simple math. It's your net operating income divided by your debt payment, your loan payment. And you want that to be, typically, it depends on who you talk to, it's either going to be a minimum of 1.2 or 1.25. So essentially, the amount of money that you get from the property before any loan payments, you want that to be at least 20 to 25% higher than whatever your loan payment is.
Which kind of makes sense.
You want to buffer.
You don't want it to be less.
That's oftentimes when I'm trying to figure out, like, how much of a loan can I get? That's the number that I'm targeting because that's what the bank cares about. Right. They don't actually care about the loan to value. What they care about is that other ratio, the debt service coverage ratio. And it just so happens.
I guess that kind of makes sense because they're like, exactly how much money are you going to be making? They want guaranteed that you can make their payment and be good, have a buffer.
Yep, exactly.
That makes sense. Interest rate, is it fixed or floating? That's kind of a big question because that's
a big deal.
Could affect a lot of different things.
Yeah, which impacted a lot of larger investors when our interest rates very quickly rose because they were on floating debt, and all of a sudden they went from having 3% interest rates to like 6%, and their debt payments just skyrocketed, and they were suddenly underwater. The cash flow was no longer a good ratio, and they had to feed it. And now it's like, okay, now we get a choice. We either we ask our investors for money, which isn't great because like there's no end in sight. B, we refinance this thing and hopefully we just lock in a long-term rate, but now it's at the higher rate. Great. And maybe hopefully by then we've done enough repairs that we're okay. Or you just sell it to someone else and
you just take a loss.
Yeah. or not necessarily a loss, but you might just break even on it.
Oh, okay. Yeah. Interesting. Okay, I'm glancing. Is there anything else people should know about fixed rate, floating rates?
If it is floating rate, ask a lot of questions about it. Oftentimes there's a cap on how high it will go. And so you can ask them those questions like, hey, what is the cap? Like, because it's like a range. They can't go up to infinity. Like they'll stop it. So you want to,
That would be terrible.
Yeah. So you want to ask what that is and be like, did you stress test it? What does the investment look like at the cap?
At the cap. Yeah.
Yeah. So those are the kind of things like you just want to know. And I get it. It's not going to perform well. It's not going to be awesome, but like, are you going to come to me for money or what's the deal?
Right. Yeah. What's the plan?
Oftentimes too, floating rate debt often goes with what's called a bridge loan. So it's a short-term loan that bridges you to the eventual long-term loan.
Oh.
So you might want to ask like, well, how long is that? You know, is it a year, 2, 3 years? Like how long do we got to get this done?
Yeah. The longer the loan, the more likely it is that it could
adjust, honestly, the longer the loan, the better, right?
Oh, really?
Because that gives you time to do whatever it is that you're doing. If it's like a 1-year bridge loan, dude, you better move fast. You're practically starting the refinance at the same time as you're buying it. So that's not good, which oftentimes, like 3 years is pretty typical type of thing. And so you want to know, like, hey, you got a construction plan. How long is it going to take you to do this? How long is it going to take you to raise all the rents? Because you got to get it to that stabilized position before you can do the refinance. Are we going to have time in the loan's term to pull all that off?
Makes sense. And then there's just some other general questions in there about loans and interest rates and lenders in general. So it's kind of like, how is the interest rate set up? Is it assumable? Does the sponsor have a lender term sheet or like all those rules that you were talking about and really learning more about it? Who is the lender? And do they have experience with this type of asset? Do they know about the market? Has the sponsor worked with the lender before? So there's like a series of questions there that's like, who is this lender?
We got an interesting situation right now where we're selling a piece of property and the buyers came to us with a loan and they told us what the terms were. It's a VA loan. And they're like, yeah, we can do 6% of concessions. And I was talking with my partner and he was like, I have never seen a 6%. He goes, that doesn't make any sense. Like I thought the cap was 4%. So we started doing some research and I was like, well, I mean, according to this, like it sounds like it can be depending on the type of expense that it is. And he was like, I've never seen this. And so that was one where we were just like, weird. And we actually called up the lender of the buyer, like, hey man, what's going on with this? And he goes, we're just being aggressive. And like, okay. To us, like you go, so you don't actually know if the underwriter is going to approve this or not. Like this feels like a negotiation type of thing.
Right.
Very strange. And so, but that was an example where the term it didn't make sense.
Yeah.
We're like, oh, we haven't heard this before. And the broker who we're working with, she seems new enough that like, I don't think she's experienced to know like, hey, this is a semi-red flag.
Yeah.
And so it feels like we're doing some coaching, some managing across the table, I guess, to be like, hey, you should really ask about these lender terms.
Right. This doesn't seem right.
This isn't normal. What do you guys know that we don't?
Yeah.
And so you get that kind of stuff where it's like, yeah, you want to ask about it and be like, oh, it's weird.
Yeah. Cause that might put you in a position where like they're saying one thing, but then when it comes down to it, your numbers aren't that percentage and the bank isn't going to loan you,
well, and that's
or let you assume that percentage.
Like, yeah, that's awesome. Let's ask. But he doesn't actually make the final decision. It's some unknown underwriter who's never talked to you, who doesn't know who you are, which they set that up on purpose.
Weird.
They're the ones who are really playing by the rule book.
Yeah.
And so, again, we're like, this isn't normal.
So this is a slight side tangent, but that's interesting to me that the underwriter could unravel a deal.
Oh yeah.
And I've heard that before. But what does that actually look like related to financing? Is it what you're saying? Like a lender misquoted something and the underwriter ran all the numbers again and double checked and was like, no.
So here's the concern, right? Let's say we're friends. We just, we get along like instant connection. And so I, as a lender, they don't want us as friends, right? Or people who have that connection of helping a brother out, right? Of giving me by giving me a loan that you really shouldn't give that's not appropriate.
Oh.
And so what they've done is they've set it up where there's some third party who let's say I'm the borrower. I've never talked to them. I don't know who they are. They may not even know what my name is. All they get is a blank sheet that says, yep, here's their personal financial statement. They're set up. Here's the loan that they're asking for. Does this make sense? Like they're trying to get to a zero bias, like just make a call type of thing. And so it's up to, let's say you're the lending officer. You're you're the bridge in between, right? You're the go-between. So what you're doing is you're saying, well, here's what the underwriters will accept. So we got to make your package look like something they'll like. And then you hand it off to them and they tell you, well, we need this or this or that. Then they come back and say, hey, we need an updated whatever because this is now old. And like they're just the go-between. They're the salesperson.
Interesting.
And the whole goal is to try to eliminate that I like you bias from the lending process.
Is it
or
solely
some sort of racism or misogynistic bias? Like just get rid of all
so
of
it's
that.
solely based on numbers, the underwriting process. They're not looking at your demographics and your backstory and all that other stuff.
No, definitely not your backstory. There might be a demographic piece there because that's important to them. But now that's like big banks, definitely the case. There are smaller regional, more like commercial sized banks where it's a similar process where you have a loan officer who then goes and presents it to, again, third party, like a loan board of a group of people. And they go, yeah, this makes sense. So you can be a little more creative in that. Like I've gone and I've supplied a business plan. Yeah. I go, look, I know you guys have asked for all the documentation, personal financial statement. Here's my business plan to go along with it to try to get them to go like, oh, wow, this guy's really
know what you're doing.
Cool, awesome. Big banks don't care. It's all, they're filling out fields
their system
in a spreadsheet and they're just looking at it. And honestly, it's probably one of those where at this point they've got computers that are given the initial thumbs up, thumbs down. And you just have a person who's looking at it going, oh yeah, here's the it's like,
interesting.
Yeah. I mean, banks, like, it's all about the numbers for them. Yeah. That's all they care about. They don't care about you as an individual.
Well, I mean, it kind of makes sense for them. It's a business decision. So
it's a math equation.
Yeah.
That's all it is.
Yeah.
And they've done the math on, well, what's the risk based on different profile stuff. So they collect all that information. And then they're saying, yeah, what are the probabilities that they pay it back for how often? I mean, that's all that they're doing. So that's an underwriter.
Yeah.
They're not your enemy. They're just neutral.
Yeah. Neutral. Double checking.
They just got an equation that they're plugging all this stuff into.
All right. Just a couple more questions. So
cool.
This next one, who is signing the loan guarantee?
That's important.
So walk me through that a little bit. What does that mean?
So oftentimes for bigger properties, they're what's called a non-recourse loan. So if you default on the loan, they can't come back and get you because there's no recourse for it. But banks, for obvious reasons, don't like that. They like to have a fallback, a backup plan.
Yeah.
So that is the guarantor.
Okay.
And for whatever reason, they've set it up where it's like you can disconnect the person getting the loan from the person guaranteeing the loan. Think of it as like a cosigner.
Yeah, that's what I was thinking is like, so this is the person who's going to pay if you don't.
I'm trying to see if I can remember the ratios off the top of my head. It's like whatever the loan amount is, or whatever the loan payment is, I can't remember which one now. You want to make sure you have enough aggregate number of people that equal the loan, or at least they can make the loan payment. I can't remember how it goes now. And so oftentimes what will happen is like, you might have a sponsor where like, yeah, we're getting this loan. We're getting this $2 million loan. You go, and what we've got is we've got this rich friend who's coming in who's saying, hey, if they don't pay back the $2 million loan, I'll be on the hook for it.
Wow. People actually do that?
Well, you get a percentage of the profits for doing that.
You get a larger percentage of the profits.
Well, you go from zero to something.
Oh.
Yeah. So let's say that maybe they're an investor, right? And they get I get their normal investment share. As a guarantor, maybe they get another 1 or 2% of the profits as a result of it. And so for them, they're like, it's worth the price.
And I suppose they do their due diligence and they trust the sponsor and
yeah.
Seems like I could make a relationship go sour real fast.
Oh, don't mess up the investment. I mean, that no matter what, that happens, right? Like
If it goes bad, it's...
Well, if it goes bad and you don't do well at it going bad, I mean, market stuff happens, right?
Sure.
Like there's nothing you can do about
things
that.
are going to fluctuate, but if you've done your math, the worst case scenario typically is like you break even.
Mm-hmm.
And
yeah, but that's what you want to ask. Who's actually backing this thing?
okay. And then this last little section is refinancing.
Okay.
So before we get into the specifics of like, what's the assumed LTV at refinance and what's the assumed interest rate and what does the NOI need to be for the refinance? Just give me like the step-by-step for refinance, the brief version.
So you buy a property, you get a loan on it, you fix it up, you increase the cash flow, right? The NOI goes up. Now you have an opportunity to refinance and potentially pull some cash out, repay investors, or maybe a lot of time has passed and you can instead, just refinance at that same level and decrease your overall payments.
So essentially you're telling the bank, my property is worth more now than it was when I bought it.
Or I got a lot of equity in it, whatever.
I want a new loan based on this new value, and I'm going to pull out the difference.
It's exactly how it works with like your primary home.
Huh.
It's the same. It's the same idea.
And you can do that at any time? Like, can you refinance a property whenever?
Yeah.
Or I guess you can ask the bank, and then they do the underwriting, and then
Banks
either they
don't
approve
care.
it
They
or
get
they don't.
paid 1 to 2% loan fees. So like, please refinance every year.
Interesting.
I mean, you don't want to because you have
fees. Yeah.
Yeah.
Huh.
And that's what a lot of people did when interest rates were slowly but surely going down. They were just like, every 2-3 years, we're going to refinance because we can get a lower rate for a better payment. So we can take more money out and keep our payments the same.
Yeah.
Like, dude, this is win-win. Tax-free money without a hit on our overall profitability. Love it.
Yeah. It totally makes sense if rates are going down.
And now we have the opposite problem, right? When interest rates went up, now you're like, oh, okay, I guess we're not going to, like, you might have, so this comes into it, right? You might have had someone who made a plan where they were like, we're going to do a refinance at the end of this project. And then interest rates shoot up. And now all of a sudden, the loan that they thought they were going to get, they can't do it anymore because the interest rate's too much.
Doesn't make
and
sense.
Like, oh, now we can't refinance. Now we can't refi out any cash to return to our investors.
Interesting. So if someone is presenting a deal to you that includes a refinance, that's maybe just a question you'd ask of, what would this look like if you couldn't refinance or didn't refinance?
As a general rule, that's how I underwrite it. I don't assume that there's a refinance for that exact reason, because it's usually a tricky way of goosing the returns for investors, because you get them a nice little cash infusion 3 to 5 years in. Right.
But you don't know what the rate's going to be in 3 to 5 years.
May or may not work. And you might still plan to do that because you goose everybody's returns and it looks awesome. And it is good to give.
You maybe
back.
don't guarantee that up
front.
front.
But when you're underwriting it, at least initially, you go, hey, we looked at this without it. Here's what it looks like. By the way, we do plan to do this. If we are able to pull that off, here's what your returns will actually look like. Right. That's a fair way to do it. But oftentimes they'll just, and there's a refinance, like they don't run both scenarios. But you want to do both because you never know. Because again, that whole situation a couple years ago, that's real. That happens. You know, I don't know, like rates right now for commercial stuff is sitting at 7.5%. That's pretty high.
Yeah.
And, but they could go higher. Like that's not unheard of in times of stuff. And no one's predicting that right now. Everyone's thinking they'll fall back down throughout the year, but who knows?
All right. Well, that is all the questions that are in this section for financing
there you
and
go.
loan.
Yeah, a little dry, but super helpful, really important questions to ask and very pointed. And it's good to know.
Yeah.
So there you are. Thanks for listening. Hopefully you also found that interesting and you laughed with a deep belly laugh on my jokes. And so if you would be interested in investing with us, being that lender who gives us awesome terms, or becoming an equity partner on a bigger deal, we would love to talk with you. And so you can learn more about us and our investing thesis on our website at furlough.com. Thanks for listening. Have a great day.